Hey everyone and welcome. So, you're getting ready for your real estate exam, you hit that chapter on finance and suddenly your brain just short circuits. You've got promissory notes, mortgages, APR, and it all just kind of blurs together, right? Don't worry, we are going to make this stuff crystal clear. Let's dive in and get you totally prepped for those exam questions.
Feeling a little lost in all the jargon? Trust me, you are not alone. But here's the secret. You really only need to get a handle on a few core ideas, and then everything else just falls into place. So in the next few minutes, we're going to build that foundation, piece by simple piece, so you can walk into that exam feeling confident and ready to absolutely crush the finance questions. Okay, let's start at the very beginning, square one. Before we get all tangled up in notes and deeds and interest rates, let's ask a simple question. Why does any of this stuff even exist? Well, it all starts with this fundamental concept of mortgage financing.
When you boil it all down, the idea here is actually pretty simple. Most of us can't just walk up and buy a house with a pile of cash, right? So we borrow money. Mortgage financing is just the formal process of getting a loan that is specifically tied to, or, and this is the key word, secured by, the very property you're buying. That security part, that's the most important piece of this whole puzzle.
You know, what's great about this slide is how it takes this huge, complex transaction and just boils it down to a simple exchange. It's a two-way street. The borrower makes a promise to pay and pledges the house as backup. In return, the lender hands over the cash to buy the house and puts a legal claim, a lien, on the property. That's it. That's the whole machine in a nutshell.
So how does this whole journey actually begin for someone who wants to buy a home? Well, it all kicks off with initiating the loan, and that means getting qualified. This is basically the getting to know you phase for the lender. And the very first step is the loan application. You can think of this as the borrower's complete resume for the lender. You're putting all your cards on the table, all your financial data, plus all the details about the property you want to buy. The lender needs to see everything from your credit report and income stubs to a professional appraisal of the property itself before they can even think about making a decision.
So once that application is in, the real investigation begins. It's called underwriting. This is the lender's due diligence. The underwriter is kind of like a financial detective. They're sifting through all those documents to answer two absolutely critical questions. Number one, can this person actually pay back this huge loan? And number two, is this property valuable enough to be good collateral if, for some reason, they can't?
And one of the most important numbers that detective, the underwriter, looks at is the loan-to-value ratio, or LTV. It's actually a pretty simple calculation. You just compare the loan amount to the property's appraised value. So let's say you're borrowing $80,000 for a house that's appraised at $100,000. Your LTV is 80%. That single number tells the lender how much skin you have in the game versus how much of their money is on the line. And for them, a lower LTV always means less risk. Okay, so let's say the lender has looked at all the risks and has approved the loan. Fantastic. Now it's time to sign the paperwork. And listen, for your exam, you absolutely, positively have to know the two most important legal documents involved here. Let's break them down.
The easiest way to think about these two documents is the promise and the pledge. They're a team, but they do two completely different jobs. You've got the promise to pay back the money, and then you have the pledge of the property as a guarantee. These two things, the promise and the pledge, are legally separate, and you have got to understand the difference between them.
First up, we have the promissory note. Just think of this as the IOU. Seriously, that's what it is. This legal contract is all about the money. It spells out exactly how much you borrowed, the interest rate you'll pay, and the entire repayment schedule. This document is the financial heart of the whole deal.
The mortgage, on the other hand, isn't about the money. It's all about the property. This is the document that essentially says, hey, if I break the promise I made over there in the promissory note, you, the lender, have the legal right to take my property to get your money back. Now, in some states, they use a trust deed instead, but don't get hung up on that. It does the exact same job. It secures the debt.
All right, so we've got the legal framework down. We have the promise and the pledge. Now let's pop the hood and look at the financial DNA of the loan itself. These are the key numbers you're going to find written right into that promissory note.
So every loan, no matter what kind, is built on these four pillars. You've got the principal. That's the actual chunk of money you borrow. Then there's the interest. That's what the lender charges you for the privilege of using their money. The term is simply how long you have to pay it all back. And finally, the payment. That's your regular, usually monthly payment that covers a piece of the principal and the interest.
Now, you're definitely going to hear the term points when you talk about real estate finance. It's super simple. 1 point is just 1% of the loan amount.
Lenders sometimes charge these points right at the beginning of the loan as an upfront fee, basically to boost their profit. So on a $200,000 loan, 1 point would cost you $2,000.
And that brings us to maybe one of the biggest points of confusion for anyone studying for the exam. What is the difference between the interest rate and the APR? I love this quote because it sums it up perfectly. The interest rate is just one part of the cost.
The annual percentage rate, or APR, is the big one. This is the true cost of the loan. Think of it like an iceberg. The interest rate is just the part you can see above the water. The APR is the whole thing. It includes the interest rate, but it also bundles in all those other costs, like lender fees and points, to give you a much more honest picture of what the loan is really costing you each year. That's why by law, lenders have to tell you what it is.
All right, we have covered a ton of ground here. So let's do a quick-fire final review to really lock these key concepts into your brain for exam day. This is the part you really want to pay attention to.
If you're going to take a screenshot of any slide today, make it this one. This table just crystallizes the two most critical comparisons you need to know. The promissory note is the evidence of the debt. The mortgage is the pledge of the property. The interest rate is just the cost of borrowing. The APR is the total cost of the loan. I'm telling you, master this table and you have mastered the core of real estate finance. So there you have it. We've taken apart the engine of a real estate loan and looked at all the fundamental pieces. The next logical step, of course, is to ask yourself, how do these pieces change when you're looking at different types of loans, like a fixed rate versus an adjustable rate mortgage? The good news is you now have the solid foundation you need to understand all of them. You've totally got this. Thanks for watching and good luck on your exam.